Welcome. Thanks for joining us again for another Retirement Defense download. Today we're going to talk about risk. How much risk should you be taking? It's amazing the people that come into our office and we visit with them about their portfolios. And when we dig in and take a closer look at what's really going on in the portfolio, many times we see somebody who's taking way too much risk for where they're at in their life. And other times we'll see somebody who's taking way too little risk for where they're at. And it's important to understand that every situation is different. What is your time horizon? Are you in your 20s and you're not retiring for another 30 or 40 years? Are you in your 60s and 70s and retirement is around the corner or you're already there? What's your income? What kind of things are going on in your overall situation? These are all factors to determine how much risk you should be taking. But once we figure out these kind of lifestyle factors and where you're at in life, what we always like to revert to is what we call the Prudent Investor Rule. The Prudent Investor Rule is a simple math equation that helps us determine how much growth you should have in your portfolio. Stocks, mutual funds that are growth oriented versus bonds or more conservative type of assets, CDs, cash in the bank. So what we want to look at is what is the Prudent Investor Rule in your situation? And it works like this. Let's assume you're 65 years of age. At 65 years of age, we would take 100 less your age. That means you should have about 35% of your portfolio in growth-oriented assets. The difference to 100, i.e. your age, 65, is how much you should have in conservative growth assets. Now you might be asking yourself, what does growth versus conservative growth even mean? I want to get an 8% return or a 10% return, or I want a 4% rate of return. Well, that's where we look at it more closely. Conservative growth is typically somewhere between 2 and 4%. You're just trying to stay above inflation. And then a growth asset is something where you're trying to get 5 to 7%. And the whole goal in retirement is to protect your assets. And when we're dealing with our clients in retirement and saying, hey, where should we be at? What's our risk tolerance? We factor everything in. We come up with that prudent investor design for them. And ultimately, you're trying to get somewhere in that 4 to 6% range. And that's what that will average out so that you don't have huge fluctuations in the market by taking on too much risk or not keep up with inflation because you're taking too little risk. So that's a brief idea on how you should be preparing your risk in your portfolio. And obviously there's more factors that go into that. That's why you want to work with a financial advisor. Make sure that you're designing a plan that works best for you. But the Prudent Investor Rule is a great way to go. So I hope you enjoyed this Retirement Defense download. We look forward to seeing you again next time.